Thanks. Appreciate it. You can get all these slides that I'm about to share, and then I'll actually have this code at the very end as well if you actually like, oh, this was good, because you don't know if it's worth it yet. I'm going to start with the regular caveat that everyone always starts with on a talk like this. Talk to your financial or tax advisor. I am not an accountant, and even if I was, I am not your accountant. So you should go talk to them. And I would also say there's just a lot of nuances to everything, and I decided to make some assumptions and not share everything so that we're not here for 6 hours. Actually, my very first run through took me 2 hours, and I cut it back. So there really isn't, I'm going over everything. So before you take a step to do something, I highly, highly recommend talk to your tax or financial advisor. And if you start talking to them about it and they're like, yeah, I've heard of this, like, go find another one who actually knows what you're talking about. Yes. Now, having said that, as you were pointing out, over the last, I guess it's like 15 years, I've purchased about $5 million worth of real estate, and more recently have started raising funds. And so this is an area that I have wanted to learn a lot about because, as you'll see, it's a huge potential for raising funds for doing deals on it. I'm also going to start with what I want you to remember, okay? And it's only 4 things. And that's it. And it will only take me an hour for you guys to figure out these 4 things. So first thing, when you hear self-directed, what that means is that you can invest in alternate assets like real estate and businesses. Almost anything. And that almost is really important, and we're going to talk about that. But that's the big difference between self-directed and what would like normally be thought of as a retirement account. Okay? We'll go into that almost. The second thing, which is really cool, which is true for like most accounts, is that they are either tax deferred or tax free. But there are times when calculating the gains can be a little complex. So we're going to talk about that as well, kind of how that works and when it gets really complex. The last one, and this is the big one, is you can roll over a 401k or a 403b or a 457 from a previous employer into a self-directed account. Again, that's normally how that works. Your 401k kind of automatically becomes an IRA, and then all of a sudden, boom, you can roll it over. And I'll show you why that's a huge deal for us. And then finally, the last thing I want you to take away is that you, as the account holder, or whoever that account holder is, you or any direct line family member cannot benefit from the investment. And this is huge. This is a big deal, the big restriction, the big caveat, and we'll go way into this on what this means. Okay? So first thing I want to do is I want to talk about number 3, those forgotten 401k assets. This is really interesting. This is the amount of 401ks, $1.65 trillion, that are sitting in forgotten or old 401k accounts. They're just there. And this is spanning about a little over 29 million people. And this number here represents a quarter of all 401k balances that are out there. And so do the quick division. On average, there's about $56,000 worth of money just sitting in accounts that people have kind of forgotten about. And it kind of makes sense if you think about it, right? Like you had a job and you go get a new one and you got all sorts of stuff around that, right? You're learning the new job, you're potentially moving, you just have new habits and behaviors and things you're all trying to figure out. And this is a very easy one to go, oh, I'll figure it out later. And then later it just never comes. And so there's a ton of information. And this, I look at this and go, ooh, opportunity. I have a hunch if we were around the room here, there'd be more than one of you who'd be like, yeah, I'm in that camp. I've got it sitting there. Here's why this is kind of not a great situation for folks. The first one is that oftentimes in these plans, they just continue to incur fees, and it's really hard to track what those fees are. They've actually researched, like they've interviewed people and be like, so what do you think the fees are? And everyone's like 10%, or how do I say it? They think the fees are 10% of what they actually are. So they're way off on what the fees are for this. And so it's just expensive. And so at the very least, even if they don't do self-directed, they should move it out of that 401k into something else. Another potential issue is that there's risk of misallocation. A lot of these are not in a balanced or target date fund. If it's at least in that, you're like, okay, we're heading in the right direction. But a lot of them were set up years ago, forgotten about, and they just may not make sense anymore. So that's another where it's highly inefficient. There's some where if they're in a low balance and that's under $5,000, it automatically gets put into what they call a safe harbor IRA, which is a checking account, essentially. It's as if it has cash. They're literally they're losing money every single day on that thing. And I know when you're thinking of it from a real estate perspective, you're like, well, $5,000 is not really enough to invest. I go, I know, but that's the seed fund that they can get going and keep going on. And the other one is just, it's a headache to track if you've got this account that you got to remember to log into, and it's just kind of different and out there. Because I used to work for HP, and I was in that situation, had a 401k, and it was in this net benefits thing where the login was like an HP login type of thing, but I wasn't there anymore. It was weird. And so that's just another one of those, yeah, it can be a little hard. So here's the bottom line. So a badly allocated, high-fee 401k, they could be missing out on several hundred thousands of dollars in foregone retirement savings over the next 30 years. And so I think there's a big opportunity for us as investors when talking with people, not advising them, because we can't do that, but talking with them, asking questions like, so do you have a 401k from a previous employer? What did you end up doing with that? Right? And you can then at that point share some general information, which you're going to learn tonight, about what a self-directed IRA is, and then encourage them to go talk to their financial planner, because you, unless you're CFP, are not going to advise them. And I think there's just some really cool opportunities for us to help people invest wiser with their funds. Okay, I have a visual just to kind of show how this all works, okay? So you got some money. Let's see, where's my, it's over here on my screen. So you got some money from your job that you have put into an old 401k. And what you can do is you can roll that over into a self-directed IRA. And it's as if, like, think Vanguard, where you can open up a Vanguard account. It's like that, but it's just a different company. And so just like Vanguard is a custodian, this company is a custodian. And when you find a property that you want to invest in, you call them up and say, hey, I found a property, it's awesome. They go, sweet, fill this paperwork, and then we'll transfer the money over to the escrow office and you'll be good to go. Like, that's how it works. So there's a bunch of advantages to doing this. The first one, which is true of all retirement accounts, it's either tax-free if it's a Roth, or it's tax-deferred. And that's just a really big deal because it allows you to get some gains and then immediately put those back into investing and then just kind of keep rolling. It's very similar to a 1031. All like the similar where you go, oh yeah, you do that because you don't get that tax hit up front. Like, it's the same concept here. So huge advantage. Another one, which I think is interesting, is it's safe and sheltered. So it's very hard, without a lot of penalties, for you to get your money. So that means it's also really hard for someone else to get your money. Like, creditors can't do it. If you get sued, it's not going to be touched. What are my other ones? If there's a judgment. And so it's one of those benefits that you hope you never have to use, but it's there. Those funds are protected. Another advantage is that it's in your control, mostly, and we're going to talk about what that means. But at the very least, you have just a lot more options of where you can potentially invest, and we'll talk about all those options in a bit. And as a result, you get true diversification. It's not just in paper assets, but all sorts of things. So let's talk about that true diversification and what all your options are. Okay, I initially had a slide that had about 1,000 words on it, and I simplified it for you. You're welcome. So there are things like paper, right? Stocks, bonds, CDs, I guess REITs are things that you can invest in. Real estate, and again, it's all the different types. There's no restrictions on the type of real estate, residential, commercial, industrial, specialized, everything. Or you can do some private lending, right? You can do promissory notes, you can do unsecured notes if you really wanted to. Those are options. If you were inclined, you could invest in cryptocurrency. I don't know why you would, but you could. And then you could do private placements. And that's not just syndications, but you can invest in someone's startup if you're like, yeah, this is a great idea. I think it's good. Like all sorts of stuff. And then finally, commodities, right? Gold, silver, oil, timber, those kind of things. It's a really expansive list on the types of things that you can invest in. And that process is the same, where you have it sitting in an account, and you call them up and say, hey, I want to invest in some private lending. I got a promissory note. I'm going to give them the funds. They go, cool. Like, here you go. Do it. It's very neat. So it's not a panacea. There are some pitfalls. So we gotta go over that. First, there is some fees and some paperwork and some time delays. So doing my research, it seems like it takes anywhere from 3 to 6 weeks to set this thing up. And it takes that long for them to verify who you are, to fill out the paperwork, to then do the transfer and get it into the account. So if you're an investor and you got a deal and we're like, we're closing in 2 weeks, it's gonna be awesome. And someone's like, hey, this self-directed IRA sounds really cool. You're like, cool, next deal, because you don't have time. And so if someone is interested, my recommendation would be, well, get it set up. At least get the account going, at least get some funding in there, if not anything. And at a minimum, they can put it right back into the stock market. They could do the Vanguard Total Index Fund if they wanted to, like that's an option. And so they can, quote, park their money in other places while waiting for that deal. But there's just a lot more paperwork than what would be normal. Another one is, with freedom comes some more responsibility. And so the government has stepped in and they have added a lot more regulations, and it is more complicated, as you'll see. It's a lot more regulated now. You can thank folks like Peter Thiel and Mitt Romney for that one, because they figured out how to use their billions with their retirement accounts, and everyone went, wow, does this seem fair that they're growing tax-free? And it's just, yes, but as a result of it, they've really started to caveat things. We're like, okay, all right, here's kind of how you can get away with it. All right, here's an interesting one. You have a loss of the depreciation benefit. So, we all love tax time, where you're like, oh my gosh, I made a lot of money. And then you add that depreciation line, you go, oh, I made a lot less money. This is fantastic. So that doesn't happen with retirement accounts. But it kind of makes sense, right? Because you have this retirement account that has this property with the investment. It made money throughout the year. It doesn't fill out a tax form. It's just there. It isn't until you do a distribution that's when the tax man knocks on the door. And so it's only at that point when you're going to pay your taxes, and we'll point out what those are. And oftentimes it's an ordinary income tax is what you'll pay if it's not a Roth. But, and this is for the most part, this is true, you just don't get that depreciation. So just something to keep in mind. It's almost like, in some ways it's fine. I don't even know mathematically how it would work if you had your retirement account was holding this, and then you get to the end of the year and like, hey, depreciation benefit, like the government's not going to put money into your account. That's not a thing. And so it's just there. But anyways, that's something to just keep in mind for the most part, and we'll get into that caveat.
You never get the depreciation ever.
That's not if you own it free and clear, correct? No. There's a caveat where you kind of do. It's weird. We can talk more about it. Another pitfall is you can have some difficulty in valuing illiquid investments, right? If you're holding real estate, there comes a lot of times where they just want to know what the balance of your portfolio is. One really easy example is if you're in a traditional, eventually you have to do minimum distributions, and in order to calculate that, they got to know how big your portfolio is. Or, and this one's kind of cool, if you're doing a distribution, you don't just have to do cash. You can do an in-kind distribution, and then they really want to know how much that building was worth. And every year, from what I've learned, it sounds like the IRS is like, hey, we kind of want to know the size of your portfolio. And it's pretty easy to solve. It's either getting an appraisal or getting a BPO from a broker. And that's another, talk to your CPA, and they will tell you what you need to do in order to make whatever the reporting is happy, satisfied.
So when you turn 73, do you have to take minimum distributions from self-directed?
It depends on the one you do. So probably, but not always. And I got a chart, I'll show it to you. That breaks it all down. The other pitfall, and here's where we're going to level up the complication a little bit, is something called the unrelated business income tax, which is related to the, what is it? I got to make sure I say it right. To the, where are you? To the unrelated debt financed income. All right, so there is a time when you have to pay a tax, it turns out. So let's, first we're going to start with the unrelated business income tax. So if you are running a business, the government does actually have a tax upon you. Now the cool part about it is, for the most part, if it's passive income, it's totally exempt from that. Now where things get a little hairy is if you have a short-term rental, it's like, what kind of income is that? Is it passive or is it active? And we can get into that. But the one that I want to focus on is the UDFI, the unrelated debt finance income. So there is a tax on the percentage of gains attributed to debt financing. So it's not the easiest thing to do, but you can actually get loans for the property you are buying with your retirement account. Now they are, what are they? They're, oh my gosh, it's not non-conforming. They are non-recourse loans, so they can't come back and get you because obviously it's like a third-party person. And so they're harder to get and qualify for, and oftentimes they're only reserved for larger businesses. The lenders who I talk to for non-recourse are like, yeah, it's a minimum of $1 million loan, otherwise don't talk to us. And so oftentimes those are used for syndications. So you might be a passive investor in a $4 million property, and you've contributed $50,000 and as a part of like $1 million total raise, and then they're getting a loan for the other $3 million, and that 75% of it now all of a sudden has this unrelated debt finance income tax that your retirement account will have to pay. But there's good news. There's hope. In this situation, now you can count depreciation and any other operating expenses. And so, yeah, kind of, you get depreciation. And what this really amounts to is the experience has been when you have the hold period for the property and depreciation is happening, for the most part, it wipes out any taxes you would have to pay. And then you only have to really do it when you sell the property, because that's when hopefully your gains are enough that depreciation, and all that recapture happens. So here's the really important part about this is that it's the retirement account, not you, that pays it in the year that it occurs. Okay, so you just want to, this is another one of those, talk to your accountant, make sure you're doing your math right type of stuff to go, okay, yes, I've got this property, I've got some debt, it's, some percentage of it is proportionate to it, I know I'm going to get some depreciation and some other expenses, what's left over, how much is my retirement account going to have to pay, and you want to make sure that there's enough funds in the account to pay, because you cannot do that. There's a lot of math, it's hard to figure out. As a general rule, again, talk to your CPA, you can assume a reduction of 1 to 2% on your overall return if you're using debt. And so there's just enough offsets that, yeah, 1 or 2% of it is what you can kind of, so if you're investing, let's say like a syndication, and like, yeah, you're going to make 15% average annual return, you go, cool, it's more like 13 for me if you're using your retirement account. Does that make sense? Okay, cool. I tried to take out all the math for that part. Okay, so that's, for the most part, those are the pitfalls, but now there are some restrictions, okay? And this is really, really important for this part. Here's the first restriction. Disqualified people cannot personally benefit directly or indirectly from the self-directed retirement account or its assets, okay? Now, who is a disqualified person? Good question. It's you, the account holder, or any of the account beneficiaries, or any direct line family members, or any entities that are owned 50% or more by a disqualified person. I'm seeing hands raised up.
Yeah, so I buy a duplex with the self-directed.
Yep.
Right? And direct line means that I cannot have my kid living in the duplex.
Correct.
I could have my cousin living in the duplex.
Yeah,
we're gonna. That's still direct line.
Yeah, we're going to get all into that.
Okay.
I'll answer it all for you. Don't worry.
Right.
Yep.
Is benefit strictly monetary?
No, we'll get into that too.
All right.
Yes. The indirect is important. Yeah. Okay, so what can't you do? There are a bunch of prohibited transactions. Okay, and so this is like the official legalese one. You can't sell, exchange, lease property that a disqualified person already owns into it, and you cannot transfer any income or assets or supply any goods, service, or facilities, okay? I know it's a lot, so I'm gonna give an example, okay? And this will help answer all those questions. So let's take a look at a family tree to help us understand what's going on, okay? So we're gonna focus on Ron Weasley here, okay? He's the account holder. He's got the guy who's got the self-directed retirement account, all right? So who are the disqualified people in this case? Pause, let you think about it, let you work it through. All right, here's the answer. All of those people. So it's Ron, his wife, his kids, his parents, and his grandparents. Notice who's not crossed out. Fred and George, if George was still alive, or Fred was still alive, good to go, right? They can still do it. Jenny's good, and his friend Harry's good. So those people are not considered disqualified people. All right, so what does this mean? It means that Ron, or more accurately, Ron's retirement account could not buy a house and then Ron manage it. That's a no-go because now Ron is benefiting it. The way to kind of think about this, here's the analogy I like to think of, is pretend that the retirement account is your enemy, okay? You would not do things to help out your enemy. You wouldn't give it free service. You wouldn't help it with supplies and materials. You wouldn't give it money. And your enemy would not help you out. It's not going to give you a place to live. It's not going to give you any money, that kind of thing. So that's how I try to think about, like, okay, personal benefit. It's not just enough to say it's my friend. It's like, no, it's your enemy. Like, that's how you got to think about it. So another example, okay? And this was the example that you came up with. So Ron's retirement account can't buy a place and then rent it to his kids. Oh, and if they ever get married, can't do anything with their spouses either, okay? And so that's a limit. Here's another interesting one. Ron's retirement account cannot buy a short-term rental. And you know what? Just like every once in a while, Ron goes and stays at it because it's really nice, or his parents do. Nope, that's a no-go, okay? How about this one for super interesting? Let's say that Ron and Hermione in an awesome neighborhood, super magical, and a house comes for sale that's in the block. And like, man, it's a piece of garbage house. We would love to buy it. Ron's retirement account buys the house, fixes it up, makes it better. Guess what? It just improved all the values of the homes in the neighborhood, which one of his can't do that either. Yeah. So you really like keep it away from you. I know, it's...
That's pretty extreme.
Well, you could rent it to his brother George for $1 a month and get an unbelievable benefit for
That sounds like an awesome benefit for the brother.
Yeah.
But, and the way it would have to be is Ron's not the one who's going to rent it to him. It's whoever is the property manager, somehow off the books, unrelated, uninfluenced by Ron, says, I like you so much, I'm going to rent it to you for $1. Yeah. Here's the bottom line, right? If there's any sort of benefit, don't do it. Like, that's the answer. I think I had, here's one. Here's a super annoying one. Let's pretend that you grew up in the Bay Area and you have two parents who are reasonably successful and they have a massive retirement account because that was what your mom did. And they're like, James, we love you. We want, or you random person, we want to help you with your syndications. I go, cool, sounds great. You can't invest, I'm so sorry. And that's my situation. And believe me, we have talked with multiple accountants like, well, what about? And they're like, yeah, no, don't do it. Like, introduce your parents to some other syndicator investor and let them invest with them. That's kind of, that's my, yeah. Another one is, let's say that Ron and Harry decide that they're going to start up a new business. And what did I call it? The Magical Artifacts and Antiques Shop, kind of an Indiana Jones meets Harry Potter. That sounds fun, right? And Ron's retirement account can't buy the building and then rent it to that entity because Ron owns 50% of it. So those are kind of like, hopefully that helps with the, okay, who's disqualified, which you can't do. Okay, is there still confusion on? All right, cool. All right, let's go back to the restrictions because that's not all. There's still a couple more, but it's not too bad. All right, I said you can invest in almost anything, and there actually are a couple things. Collectibles, apparently you can't invest in art, antiques, or stamps. Bummer. You can't do life insurance. This one I had to look up, but you can't do S corporations, and it has to do with the way they are legally structured. Somehow, if the retirement account invests, it suddenly becomes a C corp, so it's just like, can't do it. I think it's just one of those weird corner cases of stuff. And then this should make sense. You can't invest in illegal activities. I think that's fair.
Can't buy drugs. Too bad.
Yeah, I know, bummer. And just like all the other retirement accounts, you can't start withdrawing funds until you are 59 and a half. Well, I mean, you can, you just pay the normal 10% penalty on top of it. Okay, so those are the restrictions. Not too bad, not too bad. All right, what are the different types of plans that you can get? All right, so there's for your individuals. You got your classics, the traditional, the Roth IRA. You got your small business owners. There's the solo 401k, which is if you are the only one, can't have any employees unless it's your wife. You have the SEP IRA and the simple IRA. And if you know what they are, awesome. These are just like the regular ones that we all know, except you can make them self-directed. And then you have on the savings plan side, you can do an HSA, which is pretty cool. And you can also do an ESA for your kids if you wanted, which is a weird way to think about it, but you could do it. And then there's the former employer plans, like I was talking about earlier, the 401k, 403b, and the 457. Okay, this next one's an eye chart. promise I'm only going to show you highlights with it. I won't go through all of it. But this is kind of the, okay, what can you can't do? And so, you can pick your path. There's some eligibility requirements, contribution limits, which you can actually, like the type of contribution it is, the type of withdrawal, tax that you get, and then some distribution things to know about. So I'm just going to highlight 4 things. Okay, so the first one is on this traditional IRA. For the most part, it's all pre-tax until you hit a certain income limit, and then all of a sudden it's not anymore. It becomes after-tax dollars, which is true for all traditional IRAs. So if you make a lot of money, awesome. It just is after-tax dollars. The other one, and this is the Roth IRA, super powerful. First of all, distributions are not required, so that's really cool. And everything is tax-free, assuming it's after 59.5 and you've held the account for 5 years. So for whatever reason, that 5 years is important, I'm sure, but I don't know why. So the Roth IRA, super, super, super powerful. And we're going to talk a little bit later about what it might look like to convert into a Roth IRA. If you believe that your tax rate is going to stay the same when you're older, and if you believe that your balance is going to go up when you're older, I would highly, 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 highly recommend talking to your tax accountant about potentially switching whatever your traditional over is to a Roth IRA. It's worth having that conversation because the benefits are huge. Also interesting, on the employee ones, like the SEP and the solo, you can see the contribution limits are significantly higher, up to 25% of your income, which is super cool. That's how accounts can just start growing super fast if you're able to put that in, as opposed to the individual ones are a little bit lower. And then the HSAs, kind of a cool hybrid, I guess. So if you're using it for medical expenses, it kind of acts like the Roth, where there's no taxes on it, and you're not required to do a minimum distribution. But you also do have the option to use it just for regular stuff. And when that happens, it acts more like a traditional, where you just get taxed as ordinary income. So it's kind of a cool hybrid type of plan. Okay, I want to work through a couple examples on what it would look like. Let me make sure I'm doing this right. Yeah, okay, that's right. So now that I've gone over all those details, I just want to show this picture again. To go, okay, so you had some money and you had it in, say, 401k, or maybe you don't even have that. You can convert that into a self-directed IRA, and you can just start putting money directly into it. And then, assuming that it's not any of the restricted things, you can buy pretty much anything, assuming it's not illegal and stuff like that. So that's kind of just re-showing that visual after all those details. All right, now what I want to do is I want to dive into, I want to up the complication level just a little bit to show you some possibilities that you can do with this. So, like I said, one of the downsides is that there's fees, paperwork, and delays relatively when you're investing. So, if you want greater control and flexibility, and if you want to be able to make time-sensitive investments, and you want to avoid custodian approvals and fees, there's an option, albeit a little bit riskier. So let's say, I don't know, you want to go after auctions on the county courthouse steps. And if you win that auction, you got to give them a check right then and there. This current model that I've showed so far doesn't work. There's too much of a delay. So instead, what you can do is something called checkbook control. Okay, so you can establish an LLC and you get direct control over all your funds. And this allows you to make any investment without custodian approval for each transaction. Okay, I want you to be very clear here. You don't have custodian approval, which also means there's nobody double checking that what you're doing is legal and right. So it's riskier, but if you know what you're doing, it can be super, super powerful. And again, think of it as for whatever reason, that's a time-sensitive piece, or you're just annoyed with paying the fees, which honestly, from what I've researched, they're not that bad. Pay them, it's okay. But if you're interested, here's how you get it set up. First thing is you have to engage a qualified third-party professional. They will not let you do it yourself. You can't log on to ChatGPT and say, make for me a checkbook control LLC. No, it's a no-go. And for whatever reason, they're concerned about, it's something about, I'm trying to remember what it was. They just have different rules where a third party has to do it because they don't want you to set yourself up to be, to benefit yourself, I guess, is the way to say it. So you have to have someone else to do it. It costs money to do it. It's a few weeks to set it up as well. And then you are now the acting manager of this LLC, but it's the retirement account that owns the LLC, okay? So that's important. But now you, as the acting manager, go down to your local bank and you open up a checking account in the LLC's name. And then once you've done that, you transfer all the funds from that custodian into that account. And now it's just like a regular account. You can write a check, you can wire money, do whatever the day of. So if you're at the county courthouse and you win the auction, sweet, you can write a check, boom. Now your retirement account owns that house, which you will not manage. You will not repair or fix up. Someone else will do all of that for you. But you can do that. And then, let's assume you're like doing a flip and you make it all good. The proceeds then go back to the retirement account. And hopefully, nowhere along the way, did you get it? I have a friend, he uses his retirement account to invest in Florida. Because he's like, yeah, I'm not going to ever be tempted to swing a hammer and try to manage it myself. So that's how he manages the potential risk of wanting to do work himself. So that's one way to do it. And like I said, this now allows you to invest directly into deals. So visually, let me show you what this looks like. So again, let's pretend you had some money in a 401k. You put it into a self-directed retirement account, and you're like, man, I don't want to pay those fees, or I want to do something fast. That's when you can set up the Checkbook LLC, and now you can directly invest in real estate. But all the same restrictions apply, you just don't have anyone double checking you. So if you're going to do it, at least for the first couple transactions, I would still work with a professional, just ask a lot of questions. Hey, can I do this? The other thing that you really, really, really want to make sure to do is just document every single transaction. It's not enough to just have like a one line item, and it's not enough to be like, yeah, I scanned a receipt. Like, no, you want to have the receipts. You want to be able to say, here's what I did, here's why I did it, like everything. Over document if you're going to do it on your own. But you're going to move fast. Yes?
Question, so am I correct in that, in this scenario that you've laid out, say there's 400,000 in an account,
Okay.
but the house that wants 500,000.
Uh-huh.
You can't get financing to bridge the gap, correct? You've got to be able to buy the whole thing in cash.
No, you can get financing.
Actually, not you.
Well,
You can't.
But maybe that's the catch, is that most lenders won't lend you now.
Correct. Yeah, it's got to be a non-recourse
So it'd be a
type of
commercial
loan.
loan,
Yeah.
essentially.
Well, it'd be a non-recourse commercial loan, which are even harder to get.
Okay.
Yeah. Or
So basically, it's no. Like in a let's say just residential.
I got something at the end that might work for you. Okay, so we'll see if that pops up. Yes.
Maybe dumb question, but since this is a retirement account, if you buy that house in Florida that you really want to retire in, and after you're 59 and a half, you're allowed to benefit from your IRA. When you're 59
You would
and
be
a half,
allowed to
one
take
day
the
you can move in?
you could take the house as a distribution,
Yeah.
and now you can use it for whatever you want. As long as it's in the account, you cannot benefit from it, even no matter what your age is.
Yeah,
But after that, you can then take it out, and you're good to go.
so you wouldn't have to sell it upon the time you want to take it as.
Correct. Now, the government's going to,
Access to the property could be your distribution.
yeah, the government's going to pretend like it's a sale, right? It's going to like, it's a draw essentially, and you'll just pay ordinary income tax on it.
So they're going to appraise it. That amount's going to be deducted from the account. You're going to pay in ordinary income on.
Correct. And
And then you can start depreciating it immediately. Because you are now the new owner of the house.
yeah,
that you're
that's a,
That does reset depreciation.
I'm playing.
I don't know if it resets. That's definitely a CPA type of question. Yeah, that's an interesting one. I mean, in theory, I guess it depends.
I haven't owned
Depends on all
this for
sorts of
30
stuff.
years. I just bought it.
Yeah, that's a good question.
It's an interesting.
That's a good CPA type of question. Yeah.
I got a dumb nuts and bolts question.
Okay.
So the retirement account, LLCs cost money to run, you gotta pay somebody to set it up and pay an accountant and all that, right? And
Yeah.
the retirement account pays to set up the
Correct.
LLC, right?
Yep.
So here's the dumb question, or here's the weird part to me, how do you, when it hasn't been set up yet, how do you pay for it when there's no checkbook to pay for it?
You call up your custodian and say, hey, I got a legal fee here. Can you pay it
So
for me?
You call up Vanguard and you say, hey,
Or-
I need you to pay for it.
Yeah. Vanguard doesn't offer them, but a similar type of
Yeah, so you.
company. Yep.
Okay.
That's how, yeah. And that's part of why there's a delay. And what you do is you call them and say, hey, I'm setting up a Checkbook LLC. Do you have a lawyer who you like working with? And they go, oh, yeah. And they can like, I mean, they do these kind of things. So they're like, yeah, we got a process. Here's the form.
I set up a checkbook IRA, and the funds go to the Custodian was the one who set up the LLC, so it was all in-house, and
Oh, okay.
that's how we're familiar with it.
Yeah. Yeah, and it's part of it depends on who you work with. Yeah, yeah. Okay, so that's the checkbook process. Now we're going to talk about a concept called the backdoor Roth IRA. You may have heard it on YouTube. Woo! Super fun. So, like I talked about earlier, Roth IRA is super powerful because they do grow tax-free. You don't have minimum deductions. Awesome for estate planning purposes. But here's a problem. You are not allowed to contribute after your income, if you're an individual, is $160,000, or if $250,000 if you're married, which awesome problem. Everyone wishes they had, but an issue. So the solution is that you can contribute to, say, like a traditional IRA or a SEP IRA or a solo, and then you can convert that into a Roth, okay? I'm going to start with a simple example, and then I'll make a more interesting, complex one. So let's say here you are, you put money into your traditional account, and let's just say for the fun of it, you earned $250,000 that year. Congratulations, you're awesome. And so as a result of that, you contribute to the max limit on the traditional, $6,500. Sweet, it's sitting there. Now, because of how much you made, this was all after-tax dollars because of their contribution limit stuff. And so what that means is that you can then transfer it into the Roth. And if you have any gains, or if it was somehow pre-tax dollars, like somehow, you would then pay the tax, and it's a 24% or 32% federal, and then your 9% Oregon tax. Now, because of how you're doing this, you can actually pay this part out of pocket, which is nice. And so you can actually keep the full balance in your Roth. And this is what some people will do every single year. They go, yep, I've got this plan. I'm going to max out my traditional, high income earners do this, and then they convert it into a Roth. And again, the whole assumption is this is now going to grow tax-free, and the balance is going to grow over time, so it's totally worth it for me to do it. Let's talk about a more complicated example here.
That 250, is that gross or is that adjusted gross?
I was just whatever. I think my guess is that it's gross. I don't know, it might be adjusted. That's a good question. That's a good tax accountant question. Yeah. For whatever, I was assuming the 250 is the same number as the limits are using. I think I remember reading it. I can't remember off the top of my head which one it is. But yeah, whatever, not important. All right, so now let's say more complicated situation. You are actually a business owner, so you have a SEP in addition to the trad. So here's what's cool. You can contribute, let's say you're super frugal, 25% of your income into the SEP, and you can still contribute an additional $6,500 into your individual. So you can really start to pump these things up. And then what you do, and let's just say, I don't know, you've been doing this for a couple of years, and then all of a sudden you learn about self-directed accounts. You're like, all right, cool. I want to take advantage of this and move it into the Roth. This sounds awesome. So if it's been a couple years, you got a little bit of gains, and your balances are now like $126,000 and $13,650. And so now you're like, okay, I'm going to transfer it over. This is now your tax that you're going to have to pay in that year, 42 grand, which is a number. And so the whole point of me showing you this is that it's super powerful, but you just got to pay attention to make sure that you have enough money to pay that tax, because it's going to come due that year. There's no let me spread it out a little bit. And if you can't pay it out of pocket, you could always do a distribution, pay your 10% fee, and then pay it. Don't do that. Ideally, you might have to be like, let's spread it out a little bit or something like that. Again, just like you can do it, but especially when you're first getting started, you just want to make sure you're planning for that tax piece, because it's going to happen.
And the trick is you have to do it every year, because there's no model where you can go back in time.
No, you can roll over an entire balance. That's cool.
Oh.
Yeah. Yeah, so if for whatever reason you've been investing in yourself for years and you got $5 million sitting in that account, yeah, you can roll the entire thing over. That's a tax bill, but you can do it. Yeah. Yeah.
Fortunately, I don't have that problem.
I know, right? Wouldn't that be nice?
One other dumb question, so with SEPs, the 20%, 25%?
25% of your income.
Is it 25% of the income that you earn in your business, or is it 25% of the income you earn in your business and if you have a day job?
Yeah, I know what you're asking. This is one of those.
Let's ride that fence.
Isn't it also based on your tax bracket though? There's not like necessary like 24% or.
Yeah, so this is one of those areas where I simplified. There's actually 4 different scenarios that you can play with. Because there's, if you're single, if you're married and your wife has a job, but you have a business, or she has another retirement account and you don't because you're running the business. There's you both are running individual businesses, or you have a second job and you have your own retirement account, and then neither of you have anything. So and all the limits and numbers are different for all of them. And yeah, so it's one of those, let me find my situation.
Accountant around here, so if anyone-
Talk to us.
Yeah, that's just one of those, like, when I first, that big table, I actually had them all broken out, and I was like, oh my gosh, this is too much. And so I went, don't worry about it. There's limits. It's math. But the back door is a really interesting possibility for people if you're interested in going down that Roth route. There are ways to do it. I think that's the point. And then oftentimes you'll also hear it like branded as like a mega backdoor Roth. And it's like, this is the kind of stuff they're talking about, where you can just transfer a lot of money. You just be aware of that tax. All right, this is going to answer your co-investing question. So here's what's cool, is your retirement account can partner with other investors on deals. And it can be the sponsor, it could be a JV, it could be a passive investor, it can be all sorts of ways to structure it. So in this particular case, like you were talking about, hey, you've got a deal that's $500,000, you've only got $400, what do you do? This is the route that I would go. I would find someone else who's got $100,000 and say, hey, let's partner up on it. That's going to be easier and probably cheaper than trying to get a loan.
How can you sponsor a deal that
Your
trying to invest in?
your retirement account sponsors the deal.
Okay. But,
My guess is it's either JV or passive investor is going to be what happens 90% of the time. Yeah. Now here's what's also kind of interesting. Your retirement account can also partner with other retirement accounts that you own. So let's say you've got a self-directed SEP and a self-directed Roth IRA. Those two can go in on a deal, which is kind of cool. You can actually, I was researching this too, you don't have to, let's say you've had 4 different jobs and all of them you kind of had these 401ks and they all kind of came along, you can consolidate all those into a single account. So you don't have to keep them all separate if you don't want to. But you may just have for different reasons, like, these things are separate for whatever reason. Or like you've got one and your spouse has one. The 2 of those can go in on a deal. Again, the only thing you got to be aware of is you can't do any self-dealing. So no disqualified person can co-invest at any length of time. Because if you think about it, it's like, okay, let's say you got that $500,000 deal. My retirement account has $400 in it, and I've got $500 cash or $100,000 cash sitting around. I cannot invest with it because now we both benefited each other. We helped each other get the deal done. That's a benefit. So you can't do that. Which I was like, really? That's kind of a bit of a bummer. So it's a weird, so again, let's go with my parents' example, right? I'm like, hey, I found this awesome sponsor. He's doing a deal. We can both go in passively. We can't because I helped out. It's a weird, this is definitely one of those, from everything I've read, there are some people like, oh, it's fine, it's okay, and others are like, no, don't do it. So that's one of those weird gray area types of things. The camp that I've landed in is like, well, it gets the deal done, that's a benefit, probably shouldn't do it. I would abide by these types of rules, but you can co-invest. Yes?
What's the limit on not doing work on the property? So does your LLC, or if you're doing the Checkbook LLC, that have to hire the general contractor and that has to hire the property manager?
Yes.
And then can you make any decisions about?
Yeah, you can, as the manager of that LLC, you can make decisions for it, but you can't, it gets tricky really fast. I could see presumably, let's say you're doing that flip and one we're doing right now, we like to go over and just check up and make sure it's all good. That's one of those weird, should you be doing that? Because now you're kind of involved, you're giving advice to the contractors. It's a weird situation. Yeah. I mean, again, it's one of those, I guess as long as it's not documented anywhere and no one's going to talk and you don't get audited, you're probably okay. it kind of will depend on your risk profile, I suppose.
You can pick out the colors of paint, but you can't deliver them.
Okay.
Yeah, that's probably a good way to say it. You can make some decisions on its behalf. Yeah. All right, so let's say like, cool, I'm interested, now what? Now you got to choose a company to move your funds into, a custodian. And so I'm going to give you some questions to kind of help you think through, all right, how do I choose one that's right for me? And so the first one is, what kind of accounts do they offer? Like I said, there's all sorts of different types, and not all of them offer all of them. And so, so you just want to ask. And if you're like, yeah, I'm interested in maybe going down like that SEP, self-directed pathway, like you want to make sure that they offer it. Another one, this one's kind of important, is you want to ask the fees that they charge. And that's not just for setup, but also for maintenance and per transaction. I wouldn't necessarily go with the cheapest one. You know, it's all kind of, take it all into account. But it's definitely something you want to be eyes wide open on walking into it. The other one is you want to know what types of investments you can make. I know I said almost anything, but not every company does everything. And so now obviously if you have the Checkbook LLC, game on. But if you're not going to go that route, you just want to double check. Yes, if I want to do real estate, which for the most part all of them do, because it's that's pretty common. But if you're in the I want to get some Dogecoin, you might have to ask twice just to make sure that you can do that. Okay. Another question, and I think this one's really important, is you want to know the process for handling investments and distributions. And these companies, they want your funds, they want to work with you, and so they're like, yes, call us anytime. We'll spend all the time in the world walking you through it. If you've ever done a 1031, it's very similar, where you can get on the phone and you can talk with them for an hour, and they're like, yep, I'll answer all the questions you have, no big deal, because this will ultimately lead to a transaction. And so you just want to understand how that process works. And if it was me, I would go a step beyond just reading the website and taking in what you can, like call the phone number, talk to someone. It's worth it.
Quick comment on that. So if you had a true custodian of the funds where you had to call them to issue funds,
Yeah.
I think that's very true. Your statement is true.
Yes.
But if you're going the checkbook route, like they make money transactionally. So when you set that up and you get your LLC, you get your checkbook, your account set up, that's where they make the bulk of their money. And then there's minimal fees throughout the year. You don't get that same support when you call them. They can't be like, hey,
That's fair.
I want to invest in this. And so just know that.
Yeah, no, that's a great point.
Which route
Yeah.
you go, you get support with the true custodian. You don't really with the checkbook IRA. At least
Okay. Yeah, no, that's,
I'm with, which I assume is going to be the same based on the way they make their money.
yeah, that makes sense. Yeah, no, that's great. And just another one you want to ask is like, hey, what processes do you have in place to make sure that I'm compliant with all the IRS rules? Which again, is more important if you're not going the checkbook route. Because otherwise they'll be like, it's up to you, man. Go find a professional. I am not going to recommend anybody. I'm not telling you who to go with. These ones are worth looking into. They're all good with real estate. They all, they're all wonderful. I would, you can ask people, hey, which one have you gone with, and use that as a recommendation. If it was me, I'd probably do the top one because their fees are pretty reasonable. They're super willing to get on the phone and talk with you, and they do all the real estate, all the stuff. But again, all of them are good. Worth checking into if you're like, yeah, I want to know more. All right, we're rounding.
That one's literally named Checkbook IRA.
Yeah. All right, so I'm going to loop back to the very beginning, okay? So hopefully now these make a lot more sense. So when you hear self-directed, that means you can invest in alternate assets like real estate and businesses. Again, almost anything. And the caveat is less about like, well, what can you invest in? But it's more like who can benefit. Like that's really what the almost means there, okay? Number two, the gains are tax deferred and tax free, just like on a regular retirement account. But things can get a lot complicated, especially when you start bringing in debt to do deals. And that's mostly going to matter to you if you are investing in a syndication. That's when that'll probably come up the most. The third one, again, is that you can roll over a 401k or pretty much any type of former employer account into a self-directed account. Again, there's a big opportunity out there that's sitting there. If you're like, yeah, I want to do a deal that's not my parents or not my kids, maybe it's a brother, I don't know, because a brother's totally fine, then you can do that. And then finally, again, this is just the most important one, is you or a direct line family member cannot benefit from the investment. I think if you keep these things in mind, you're going to be on a pretty good track. And so I know, and I'm going to open it up for questions in a little bit, but there's a lot to talk about. I love talking about this stuff all day long. There's a bunch of ways that you can connect with me. We got a new podcast dropping tomorrow. Woohoo! And then that QR code and the URL will get you these slides if you're like, yeah, I want a copy of them because it's all good, and you'll just get the PDF and you can do it because I think we're all here to learn together. So, I did all right. Yeah. So are there any other, I know you guys did an awesome job asking questions while we went along, but any kind of like, well, what abouts or clarifications that I can try to work us through?
I've got one.
Yeah.
So I have a farm property,
Okay.
and there's this woman who owns like 45 acres all around me.
Okay.
But there's this 10-acre piece right behind me that's just dirt.
Okay.
I want this 10-acre piece, and I want to buy it in my self-directed.
Okay. And the other farm you own, like you own it, your personal? Okay.
Yeah. So I benefit in that nobody can build a house in front of me,
Uh-huh.
and I benefit.
Are you going to do anything else? You're just going to leave it as dirt?
I think the plan would be to just kind of protect that space,
Yeah.
and then potentially subdivide it and sell those lots like down the road, years from now, many, many years.
After 59 and a half?
It could be, I mean, if the dirt's owned, it could be subdivided inside of the LLC. It's not until it's sold that it's,
Yeah.
it would incur the fees of like replatting and things like that.
Does it already have a selling tax ID?
It does, yeah.
So my head goes to thinking about the benefit part of it, right? When you were like, it's just dirt, like you're probably okay because there's no financial, like they can't look at the value of the property and go, wow, this went up because you bought it. Like, I think you're okay there. It's when you start saying, I subdivided it, and I guess as long as you're selling it to other developers and you're not developing it yourself, like, it might be okay. That's definitely one of those like, you should chat with someone first. But I think if you're the one or if your retirement account is then going to develop it, that will have an impact on your land. And that's probably probably not situation.
Yeah, I suspect, can't tell the future, but I suspect we would be gone from our property before we ever did anything with that one.
Okay. Yeah, I could see that too if you're just like, you sell the farmland first and then do something on that other property. You couldn't bundle them together. Would you ever want to do that?
Yeah, I mean, it's possible that we could.
Because that would be an issue.
Yeah, there's got to be a way around that somehow. Yeah. Anyway.
Yeah.
It's a weird one.
Yeah. No, that's a good. Yeah, the whole indirect benefit thing is very gray area squishy. Has been my observation, and everyone's always like, "Where's that line? How close can I get to it?" Because we want to benefit.
Yeah, if you're creative and you're a real estate investor, just checkbook, IRAs, caution. Like, use caution. It's just right there on the corner of your desk.
Yeah.
You can do a lot of creative stuff.
Yeah.
But it's very tempting.
In a lot of trouble.
You
Be
can't.
careful.
So yeah, I'd say know yourself.
Yeah.
I shouldn't have one if I'm doing
That's awesome. That's funny. Nice.
So piggybacking on Pat's question, so you have a retirement account that has a minimum distribution rule.
Yeah.
And let's say you've used most of it or all of it to buy one piece of real estate. And then you hit that minimum distribution rule, you have to distribute something to yourself.
Yeah.
What's the process? Do you wind up having to sell the whole thing? Or can you, okay.
Yeah.
All right.
But you didn't have that you have to take distributions when you had the self-directed.
Yeah, depends on if it's like a traditional self-directed IRA account, then yeah, you will have to.
But if it's a Roth, no.
If it's a Roth, you're good to go. You don't have to if it's a Roth. Another reason why Roths are kind of awesome. But yeah, no, that's a thing. You gotta either you're able to do it through cash flow or you gotta sell the asset or.
Some calculations on my cash flow.
I guess you could potentially like get a small non-recourse loan on it. I wonder if you could have someone else loan you money through their retirement account to help you pay this, and then you pay a small percentage to them.
So you can hold.
But you got to have the cash somehow.
You can hold rentals in an IRA, in a self-directed, and if that was building a pool of income aside from the property, so it's growing, right?
Mm-hmm.
Say you use 100% of it to buy a property, but it's a rental, and so every month,
Right.
there's like a little side
Yeah.
pool of money growing, then you can theoretically take your draw on that.
Yes.
money, right?
Yeah. You just gotta pay attention to that. You gotta make sure you have some capital around. Honestly, you should have some capital around just as an emergency fund, because if something comes up, you can't just be like, oh yeah, let me spot you 10 grand to fix this electrical problem. No, like it all has to come from that account. So you don't want to put 100% of your funds into a property. If you're a passive investor, I guess maybe you can get away with it. There's always a threat of a capital call, which could be an issue. But
So this raises some interesting questions, because I'm gonna turn 73 next year.
Okay,
And I'm
yeah.
gonna have to start taking, so I've got a straight IRA, I've got a self-directed, and I've got a SEP.
okay.
Can you combine all of those to take, so in other words, I don't wanna take out of my self-directed, but if I combine the value of all those and take out the, whatever, 4% it is, can I just take it from one of the three accounts? Or do I have to take equal
Ooh.
distribution from all three of them?
That's a good question. I don't actually know the answer to that.
Probably an account.
Yeah, that's a good accountant question. Yeah, I don't know. I can guess, because when they're doing the calculation for like your contribution limits, they pool everything together. You know, so like you could in theory have like 10 IRA accounts, but they're like, yeah, but the limit is 6,700. Which, by the way, these things all move. They're already trying to guess what they think 2025 numbers will be. And my guess is when it comes to minimum distributions, they also pool everything together.
And you can take
That's
out,
my guess,
Yeah.
based on what I know from the contribution, how that works.
so if you just kept some in your traditional IRA, you wouldn't have to necessarily take from the self-directed. That's it,
Yeah,
but it's an account question.
yeah, because those are also different types. And so the math might be different. They might split those up because they're different types.
So if I had a self-directed, let's say I had like, I don't know, $50,000, and James, you had a deal that you were doing like a short-term flip on, and you were just needing gap funding
Yeah.
to fund. So would my retirement account get a trust deed that I would sign, or how does that work?
Ooh, who signs it? The answer is yes. They would get a trust deed.
Okay.
And I don't know, it might be the custodian who signs it for you. It might be the beneficiary. I'm trying to think. What normally happens with a trust? It's whoever that trust,
Okay.
whoever that signer is for it. My guess is the custodian, but I don't 100% know.
Okay.
But there would be one. Fundamentally, there is one, and that would just be one of those, probably talk with the custodian to figure out who's the one to sign it.
But
If
I
it's a
had
checkbook, then it doesn't matter. Then
yeah,
it'd be
manager.
you as the manager would do it. Yes.
Gotcha. Okay.
Yep.
You know.
Yeah. Sure. This is one of those where, like, it's funny. I just so happened today, I talked to 7 people about this because they're like, "What are you doing today?" I'm doing this, and I was doing this thing at my kid's school, and I talked to a bunch of dads, and they're like, "Oh, this is super interesting," and very quickly, like trying to explain it all in 30 seconds, I was like, "Yeah, it doesn't work. It's it's kind of complicated," and also it wasn't like the most exciting thing ever. I remember for lunch I was like, "Yeah, I'm talking about this." Like, "Oh yeah, that's cool, that's cool." And I was like, "Okay, and I'm also buying a mobile home for $1." Like, "What?" And I was like, "Yeah, I get it. That's more exciting." So it's like this dual. It's complicated and not the most interesting thing in the world. And so it's just hard. And so that's been my observation too. Like, you guys are already like top 10% of knowledge right now, just from having listened to this. Because most people, the reaction is, "Yeah, I've heard of that. You can buy real estate, right?" And like, that's kind of where the knowledge stops. And so I think for us, that's where we can walk in and be like, "Yeah, you actually can. There's some restrictions, and it can get complicated really quick." Step number 1, talk to someone who knows what they're doing, like a financial planner, and they can kind of walk you through, figure out the best account if you're interested in doing real estate or any other type of investment. And again, yeah, especially if they're like, "Yeah, I've got this 401k, I've got like $56,000 sitting in it, I haven't done anything." Like, cool, all right, here's an idea since it seems like it's found money. And so, so yeah, that's what I got. Any other questions, comments? Cool. All right.
Good information.
Thanks, guys.
Thank you.